Hi everyone, thank you for joining. We will be starting the webinar in a couple of minutes. Please bear with us. Hi everyone, thank you for joining. We'll just give it another minute for a few more people to join. Hi everyone, thank you all for joining today's webinar hosted by Trove Research. Today's webinar will be covering the review of the voluntary carbon market in the first half of this year. My name is Ashley and I will be hosting today's webinar alongside the Trove team. Today's speakers include Guy Turner, CEO and founder of Trove Research, Greg Ramazars, who's our lead analyst for pricing, Dr. Alexander Koch, who is our lead analyst for climate science, Mark Statham, who's our analyst for demand, and Ben St. Laurent, who is our analyst for policy. Before we get started, we're just going to go over some house rules. The first half of today's webinar will be a presentation by the Trove team, followed by 15 to 20 minutes of Q&A at the end. All attendees are automatically muted. If you have any questions throughout, please insert them in the Q&A function, which you can see on your screens. The slides alongside the webinar recording will be uploaded to the Trove Research website tomorrow. If you have any questions regarding any of the material in the slides, please email ashleypatel@troveresearch.com. I will now hand over to Guy, who will take you through the presentation.
Thanks, Ashley. If you just want to move on to the next slide. Great. It's great to see you all, although I can't actually see you. It's good to know that you're out there. These are strange times in the world. A lot of things happening environmentally, politically, and economically. So it's a really important staging post mid-year to take a stock of where we are on all things to do with corporate climate action and the carbon markets. For those who don't know Trove Research, I assume that a lot of you do on the call, but a quick recap on who we are. We're a specialist data company that monitors, tracks, and analyzes and forecasts all things to do with corporate climate commitments and their use of carbon credits. We have policy teams that track and monitor all the policy initiatives that are trying to influence this space. My colleague Ben here will talk more about that. We track all carbon credit projects and transactions around the world in a lot of detail. We also look at all the corporate climate commitments and quantify their effect on the market and where they're going. And we also do a lot of research and data gathering around carbon credit prices. The fifth piece of the jigsaw, which hasn't been presented before, is the forecasting module that culminated in a long-awaited piece of work 2 weeks ago, which is our global carbon credit price scenarios up to 2050, where we set out 4 consistent scenarios of how this market may evolve over the next 30 years, built on the global geospatial modeling and a lot of economic analysis and market analysis underneath that. So if you want any more of that and more on that, please let us know. So we've been very busy as well. We've updated a whole bunch of new features onto the platform, the pricing scenarios analysis. We also have added a consultation tracker, which keeps track of all open consultations, interactive price dashboards for all different project types, advanced mapping of RED+ projects using satellite imagery, updated performance metrics, looking at the actual performance of projects compared to anticipated, modeling of the pipeline of projects that are pre-registration and understanding how that volume may flow through into the market and affect prices, and also which companies are currently retiring credits or likely to retire credits based on their claims, such as carbon neutral. And later this summer, you'll see a new look Trove. We've been busy in the background building a new website, so if we'll keep the purple. I know some people some people have views on that, but will be retained. But you may see a new look front end. We'll be launching detailed analysis of what's going on on host countries in terms of their policy and regulatory environments that may affect the generation of carbon credits, and which companies are currently using carbon credits and how many. So on the demand side. So it's very busy, and hopefully this will give you this webinar will give you a really good sense of where the market is heading. So right now we want to take stock, and Alex will just walk you through remind us why we're here. We talk about the market, and it's a financial world that we live in a lot of the time. But the reason why this market exists is to address a hugely important problem in the world, and it's worthwhile just reminding ourselves of what state that problem is in. So, Alex.
Thank you, Guy. Yes. So just very briefly, as you may be aware, so the world has now warmed to about 1.2 degrees above the pre-industrial baseline, and we're edging closer to the Paris Agreement targets of 1.5 degrees, and we're projected to reach that within this decade. And currently, we're in a La Nina year, so the El Nino and Southern Oscillation is the biggest driving mechanism for interannual variability and really setting our global temperature each year. And in very brief, explanation, it's a reversal of the trade winds between South America and Indonesia, which leads to warm and cool pools in the Central Pacific. And then when there's a warm pool happening, we call it El Nino. It's as a rule of thumb, you get very hot global temperatures, you get droughts in melting places. And then when there's a cool pool, as it happens now, as you can see in that figure up there, in the Central Pacific, we call it La Nina. And usually it's a cooler weather and cooler climate patterns with more rainfall. But instead, this year has kicked off with a lot of heat waves in the Northern Hemisphere already. So, for example, in India, we've had in March a heat wave that was exceptionally long and started much earlier than previous years. Heat waves also become more frequent. For example, in the US, they already experienced multiple heat waves this year, starting in late June and now in July. And the US National Weather Service just announced that more than 60 daily high temperature records have been broken in July alone. Likewise, in Taiwan, Taiwan's temperature record had been broken from last year from 41.4 degrees. That is 1.2 degrees higher than the previous record last year. Europe, as some of you might know, also is just coming out of a heat wave, and records have been shattered. In the UK, for example, we surpassed the previous record from 2019 by 1.6 degrees and reaching 40.3 degrees in Lincolnshire. China, as an example, has been hit by 1/2 of climate change impacts with heat waves in the north and extreme rainfall events in the southern province of Fujian, Guangdong, and Guangxi, where they experienced between May and June rainfall twice the normal amount. And of course, many areas, as you can see in that figure in the map, in southern Europe and the Mediterranean, currently experience extreme fire hazard conditions. And a recent study has shown that these adverse conditions are becoming more commonplace as a result of increasing heat waves and hydrological droughts. Now, lots of countries and international bodies are recognizing this. Even in places where governments are failing to do so, they're then being forced by other governmental bodies to take action. For example, in Brazil, where the local high court now requires the government to reinstate the climate change fund that had been scrapped in 2019. In June, the NATO also announced their commitments to reduce greenhouse gas emissions by 45% by 2030 and achieving net zero by 2050. It is calling climate change the overarching challenge of our time. And going a step further, in Finland, it's becoming the first high-income country to turn their 2035 net zero target into law. In the meantime, other countries are risking watering down their commitments. So, for example, the US Supreme Court curtailed the EPA's powers to put state-level caps on emissions through the 1970s Clean Air Act. This is not the only tool they have, but this is one big tool in their toolbox to curb emissions, and that's been blunted. Some of Europe's largest economies, Germany, Italy, are considering a revival of coal to bridge the transition away from Russian gas, which could endanger Europe's 2030 exit from coal targets. And in the UK, in good news, the High Court has ruled that UK's net zero strategy is too vague and needs to be updated within the next 8 months. At the same time, the two conservative contenders for the Prime Minister job are both hardly champions for the climate, with Liz Truss as Environmental Secretary rolled back support for solar energy, and she supports fracking in the north of the UK. And Rishi Sunak, while having less of a history on climate-related policies, has not acted on the Climate Change Committee's advice to remove tax breaks from fossil fuel companies. So this all shows really that corporate action on climate is much, much more important than ever. And with that, back to Guy.
Thank you, Alex. So what are companies actually doing? What is their response? And at this point, I hand over to our corporate analyst, Mark.
Hi, everyone. Thank you, Guy. So in the below, I provide a snapshot of Trove's corporate climate commitments database product. So within that product, we track a variety of different corporate commitment types, which include both corporate net zero and emission reduction targets, as well as also carbon neutral claims. In the below, we look at the growth of companies setting targets with the Science Based Targets Initiative, or otherwise known as the SBTI, which is widely considered to be the highest standard for corporate net zero commitments that align with the science. And it's clear from that despite the economic climate, there's a continued momentum for corporates to set ambitious targets, particularly through the SBTI itself. So there are now 3,273 companies with an SBTI approved net zero target, or who have committed to setting one, which is an increase of 631 companies versus the end of the first quarter of 2022. And in terms of quarterly change, as we drill down into the different aspects of the SBTI's commitments, there were 210 new companies in the second quarter of 22 to set a 1.5 degree Paris-aligned target and have that approved by the SBTI. There were 44 new companies to set targets that were classed as well below 2 degrees, and one company set a target that aligned with a 2 degree scenario, which is gradually being phased out and replaced within the SBTI's guidance with more stringent targets. Of these 255 new companies that set a target, there were some big names included in there, so Volkswagen, Heidelberg Cement, and American Airlines, to name a few. And Trove not only tracks these commitments, but also uses the data that these companies disclose to model emissions and to model, therefore, incremental credit demand up until 2050. So from these 55 companies. We've modeled emissions to represent nearly 1.2 gigatons of emissions across scopes 1, 2, and 3. And our long-term credit demand model estimates that should all of these companies meet their long-term 2050 net zero targets, that could result in a 62 megatons of incremental removal credit demand by 2050. I'll pass back to Guy now to have a look at issuances.
Thanks, Mark. And that analysis of the SBTI, changes in the SBTIs is a fraction of the work that team does in tracking over 5,000 company commitments. So on issuances on the supply side, this is our sort of regular chart that shows the issuance profile going back to 2015 by project type. So from carbon capture and storage through to fuel switch, renewable energy, and RED plus and nature restoration. And you can see it follows a peak and has been declining from over 100 million tons of issuances in Q2 2021. And now sort of running at 70% of that, so 70 million tons issued in the second quarter of 2022. That's how many credits are being produced by the projects through their annual verification or their verification process. If you go to the next slide, but it's the retirements really that are the sharp end of the market, because that indicates the removal of carbon credits from the systems that cannot be used by anybody else. So associated with claims often around carbon neutrality or climate neutrality. And you can see a similar profile, a peak in 2021, slightly later peak in Q4. There is a seasonality to retirements. Usually Q4 is a busier a busier quarter because companies are looking to calculate their obligations or liabilities by the end of the year and using carbon credits in that final quarter to compensate for that year's emissions. But nonetheless, we have, there is a decline, there is a fall off. There are some economic challenges, as we know. Inflation in Europe, in particular, is running at over 9%. Brent oil is over $100 a barrel, and interest rates are increasing around the world, and budgets are getting tightened. So there is an effect, that upward trend in offsetting in the use of carbon credits. So that has been sort of curtailed, we hope temporarily. But if you look at what's driving that, it is very closely related to the economic environment, and this is the S&P 500 index overlaid over that issue, that retirement profile, and you can see a very significant correlation there. So the carbon market, the voluntary market, is not immune from those external forces. One hopes that the commitments that Mark ran through are maintained, and we've said should be maintained by companies that set them. But in the shorter term, there is fluctuations in terms of budgets and how companies are approaching it. But an interesting angle on this is the proportion of carbon credits that are being retired in each year. So this is an analysis that looks back over the last 12 months, and the proportion of credits that are being retired by different project type. And interestingly, the attraction of nature-based projects, RED plus and nature restoration, has maintained its at about 25% on average of all retirements over the last year, in spite of them being more expensive. They cost more, they're more expensive in the market to buy for a number of reasons. They're very good for the carbon point of view, but also they have additional ecosystem benefits as well, and biodiversity. So that's a positive trend, particularly the difference between April and May. After a dip in April, RED and nature restoration use of those credits nearly doubled. The other interesting trend here is the increasing use of more engineered solutions, potentially less, perhaps regarded as less high quality, projects or credits, so non-CO2 gases, carbon capture and storage, and some aspects of fuel switch and energy efficiency. So the proportion of credits being retired from those sources has actually increased, and the squeeze has been put on the renewable energy, the type of renewable energy projects in the middle. But another angle on this, if you go to the next one, Ashni, is the age of credits that are being retired. So the last 12 months profile of the proportion of credits by vintage is shown here in this chart, with the darker colors at the top representing the most recent vintages. So in the first quarter of this, in the second quarter of this year, there was an uptick in the use of more recent vintages. So 2021 and 2020 now accounting for 22% of retirements in June. And that could be regarded as a positive sentiment that in spite of the economic climate, the companies that are still active in purchasing credits are trying to maintain impact and do the best thing they can with the money they have available in buying high quality credits and more recent credits. But that's not the whole story, because if we look at the profile of vintage use by project type, and we look at nature-based credits, this shows the profile of vintage. So on the x-axis, we've labeled this as T-1, T-2, T-3, etc., going back over time, representing the year before, or the retirement period in question. So H1 this year in 2022 on the bottom, and H1 2021 on the top. And those profiles at the first blush look reasonably similar. There's a slight difference. If you look at the overlay on the chart on the right, you can see that the first half of this year used slightly more credits of 4 years old, and slightly more in 10 years old than the previous year. And there was a peak in 2021 of 7 and 6 year old, 6, 7 and 8 year old vintage credits. But overall, zooming out, the profile is probably not statistically sort of different. But if you look at non-nature based credits on the next slide, so this captures renewable energy, non-CO2. So this actually just captures CCUS, so carbon capture, utilization and storage, non-CO2 gases, fuel switch and other. When you look at the profile, the vintage profile of these projects over the last first 6 months of this year, this year has used significantly more older vintages, trading at lower prices. So the story of the market in the first half of this year is really one of two halves. There's a sort of top half of the market which has maintained its focus on quality and near vintage, recent vintages for high quality, particular nature-based projects. But at the lower end of the market, there has been I think this is where the price pressures have been more acutely felt. Companies have tried to maintain their commitments, but sort out the cheapest possible credits of non-nature-based types and of older vintages. So you can see on the chart on the right, H1 2022, first half of this year, using significantly more projects of even 15 years old or more. So that's perhaps a believable consequence of the economic situation. Now, in terms of the surplus, the fall off in retirements has had an effect. The retirements tend to move more quickly than supply. So retirements have come down. Meanwhile, supply sort of lags retirements. And in that situation, you get a build up in surplus. And the market surplus, defined by the number of credits sitting in registries that have been issued, not retired, now stands at 621 million tons. And that's a pretty substantial amount. It's 6% higher than it was in Q1. Now, the comment on this chart is always, well, not all those will ever see the light of day. They're so old that a lot of them just won't be, are not sort of tenable in terms of use against corporate climate targets, and we hope that's the case. As I said, the recency trend towards recency is very prominent in nature-based, although we have shown also that the market still does have an appetite to retire some pretty old non-nature-based credits as well. And if you look at the what that means in terms of what we call the surplus lifetime, so this line shows the ratio of how many years the surplus would make up at that point at the demand at that point in time. So back in 2016 and 17, we were looking at about 5.5 years worth of surplus given the demand that was in the market at that time. And that line has come down over time as demand has increased. The demand has increased more rapidly than the surplus has increased. So by 2020, we were looking it was about 3.5 years worth of surplus in the market, and that fell to 3 years at Q4 2021. But now we've seen that reverse and an inflection has occurred. So in Q1 and Q2, the number of years as it started to increase, the number of years over which that surplus would be used at current levels of demand has now gone back up to 3.5. So that will possibly have an effect on prices over the rest of the year, at which point I hand over to our head of pricing, Gregoire.
Hey everyone. As I'm sure most of you already know, Q2 has also been characterized by stagnating prices after the Ukraine war broke out. These prices have stayed below Q1, but above pre-COP26 levels. And just like retirements, they have largely correlated with global equity markets, declining by 13% overall between early April and late July 2022, down to 7.5 USD per ton as of last week. Trades volumes have plummeted, but despite that, the higher bound of the trade price has gone up, with some REDD+ projects now trading small amounts of credits at roughly $30 per ton. And the volatility has been relatively low, while differences across project types have been mostly consistent. So these will be kind of the silver linings of this stagnation. The price premium of nature-based projects, for instance, has remained with prices around $12 per ton, while the premium of more recent vintages has consolidated around $8 per ton for credits with vintages later in 2013, while older vintages were consistently below by at least $1. We could see that premium to the next slide, if you don't mind. Thank you. So as you can see, it's still, the gap is still there. Some other micro trends that have emerged, such as a more pronounced volatility in nature restoration projects due to policy shifts across the world and a number of consultations around methodologies such as IFM, as well as a recent rekindled demand for clean cook stoves and energy efficiency project at large, which have brought prices up to $9 per ton in recent weeks, though there's no telling how these trends will evolve in the next month. Thank you.
Thanks, Gregoire. And that leads us on to our final speaker, which is Ben, who will just give us a quick overview of the key policy themes that have been driving the market in the first half of this year and things to look out for in the second half.
Yeah, thanks, Guy, for the introduction. So it's important to note that these trends don't happen in isolation. So we on the policy team at Trove track momentum, consensus, and consultations on several topics from a range of stakeholders. And we've seen the scientific and economic context of the market. And it's also important to look at what standard setters and guidance bodies are saying as well. So far in 2022, we've seen a number of key developments emerge on government and regulatory action and the use and quality of carbon credits and corporate climate ambition more broadly. So far in 2022, we've started to see climate-related financial disclosures, which we're reporting growing interest across different jurisdictional regulators, most notably in the US, but also in Europe, Canada, Brazil, Hong Kong, and others. On the use of carbon credits towards net zero claims, the VCMI is working to define how high integrity credits can be used towards corporate claims and the consultation on its provisional claims code of practice remains open through August 12th. There are other efforts to define high integrity use of carbon credits that have surfaced from the Nordic Dialogue, the WRI, the Tropical Forest Credit Integrity Guide, and Gold Standard. Investors' expectations from companies are also becoming clear. The credibility and transition plans and the ambition of short-term targets are coming under greater scrutiny, coinciding with new guidance from the Glasgow Financial Alliance on Net Zero, or GFENS, as well as the Race to Zero. Corporate ambition on preventing deforestation has also gained momentum, but the way to achieve this is less clear. Race to Zero recently updated its starting line criteria to include a no deforestation commitment, which is something that will also be included in the finalized SBTi flag guidance expected in Q3. Vera and ACR both moved to restrict the creation of crypto carbon tokens based on retired credits from their registries. This is probably not the end for crypto tokenization of carbon credits, and Vera is keen to resolve this with new pre-retirement status for tokenizing credits. There have also been significant movements in EU climate policy through various channels. The EU ETS reform, the Carbon Border Adjustment Mechanism, or CBAM, and the EU Sustainable Finance Taxonomy represent positive developments, but higher ambition on some of these proposals has been blocked. So looking forward, 2022 is shaping up to be a big year for climate policy. Looking ahead, our policy team is tracking several key updates expected by the end of the year. At or before COP27, we expect countries to make progress on implementing corresponding adjustments and negotiations in Sharm el-Sheikh to clarify requirements for Article 6, including the role of host country authorization, the application of corresponding adjustments, voluntary credits, and other key items. The delayed release of the core carbon principles by the Integrity Council for the Voluntary Carbon Market, or the ICVCM, could set a higher benchmark for defining credit quality, which would be above current credit standards. Vera has also delayed the release of methodologies for avoided deforestation, which could bring projects more in line with jurisdictional emissions baselines. Before the end of the year, the SBTi will have made significant progress on the net zero standard for financial institutions, which isn't expected to be finalized until Q1 of 2023. As the SBTi adds new sectoral guidance, it will also be interesting to see whether they go beyond defining emission reductions pathways to set other requirements, similar to the no deforestation commitment for forestry and agriculture. Also, the SEC in the US will finalize climate disclosure requirements by the end of the year, with greater uptake of similar requirements in other countries expected as well. And the last key trend that we're tracking that I'll mention today is the ISSB's efforts, or the International Sustainability Standards Board, efforts to harmonize disclosure requirements and create a global baseline for sustainability related reporting.
Ben, thanks. We sort of have competitions in terms of who's the busiest, and I think given what Ben said, he might win that competition. There's a lot to keep track of there. So, Ashni, back to you.
Hi, thank you. So I'm now going to launch this webinar's poll. So for today's webinar's poll, we've got 3 questions where we will be asking you guys what you think, what your expectations are for carbon credit prices by the end of the year. So you should now be able to see the poll on your screens. We'll just give you guys a couple of minutes to answer those questions. The first one is, what is your expectation for carbon credit prices in dollars for the year end 2022 for renewable energy credits? There is then a question on your price expectations for REDD+ projects, and then finally your price expectations for nature restoration projects. We'll just give you another 30 seconds.
If I could just interject here, this is the same poll that we launched in our Q1 update. And so we asked exactly the same questions. What is your expectation of carbon credit prices by the end of the year for three categories: renewable energy, energy efficiency is question 1, RED plus credits for question 2, and then there's a third question. If you want to scroll down, and Ashley, I think there's a third question underneath. Nature restoration. So please do scroll down, and you've got three questions. So this is the same question that we asked in Q1, and we want to compare where the market thinks where the market will end up by the end of the year, where people think that's going to, today's view compared to the one we did earlier in the year, to see how that will have changed.
Great, thank you, Guy. I'm now going to end the poll, so thank you all for your responses. You should be able to see the results pop up on the screen.
We write these down: renewable energy, energy efficiency credits. The mode, i.e. the most voted one, is 7 to 10. Okay, interesting, with a pretty short tail above $14. So more bearish 3 to 6, just short of 7 to 10 on renewable energy credits. Very few people thinking the price would go beyond $14. Okay, good. I will note that down and compare that. Now, red credits, question 2. I'm scrolling down. Is everybody else? Can anybody? Oh, you can see that. So red credits, the modal, i.e. the most commonly voted for one, is 11 to 14. Okay. More of a normal distribution around that, around the central. Some folk looking at 7 to 10, some 15 to 18, and a few at 19, 20, 23, 26. But if I just say 11 to 14, interesting. And then question 3, nature restoration. Okay. Unmute myself. 11 to 14, 15 to 18. Okay, interesting. With a quite a long tail above that 14 mark. So quite a bullish sentiment on nature restoration. Quite a few people thinking it could go above $26. Okay, if you just want to go to the next slide, Ashley. These were the results of the Q1 for price expectation questions. So renewable energy projects, $7 to $10 was the modal outcome there. That is the same as what we have today. So we had the most commonly voted for price band for renewable energy credits was $7 to $10 that we just saw, and that is the same as what you thought in Q1. Red is different. The red plus in Q1, you thought the most commonly voted for price band would be $15 to $18. The market now is a bit more bearish. The profile, if we could overlay the profiles, you would see it more clearly. Just couldn't do it in real time. Oh, well, Ashley's one step ahead of me. We just can't overlay the two. But if you want to go back to the previous one, Ashley, the dark green, which is red plus, the most commonly voted for price band in Q1 was $15 to $18. We now think the market currently, based on the current poll, is $11 to $14. So the market is a bit more bearish on the outcome of red plus credits by the end of the year. Nature restoration is fairly similar. It's similarly bullish. The most commonly voted for price outcome was $15 to $18 in Q1, and it's still $15 to $18. It's actually, if you flip to the following slide, it's a similar profile actually above that midpoint. So the conclusion from this wisdom of the crowd is that the market seems to be more bearish on renewable energy, equal on renewable energy type or energy efficiency credits, more bearish on red plus, but not by much, by one notch, one price band, and equally bullish nature restoration in $15 to $18 as the most voted for price band. So interesting thoughts from yourselves. Thank you for that, and hopefully that was interesting for yourselves. So questions, please. We have 20 minutes left for Q&A. I'm not allowed to see the questions, nor my team. So Ashley, do you want to be master of ceremony and pick a few for us to answer?
Yes, thank you, Guy. So we have quite a few questions from the Q&A, so thank you all for submitting your questions. The first question is on the topic of high quality removal credits. First, what counts as a high quality credit? And then when will there be a global definition of high quality? And when will that be agreed? And then also, what is the outlook for high quality credits versus others?
Well, those are very topical questions. I'll take a first stab at that, and if any of my colleagues want to pitch in afterwards, just raise your hand. It's a question that is often asked. I think there are two levels to the answer. One is a sort of top-down approach. What is high quality? From removals, in our view, removals are nearly always high quality because there is very little, particularly from the point of view of additionality, because there is relatively little, there's very few other reasons to suck CO2 out of the atmosphere other than for climate change purposes, and there are very few other economic incentives to do so. There are potentially at the edge some arguments about subsidies for reforestation activities that may or may not sort of encourage to be viable economically in their own right. Maybe an overlap with commercial timber, and sort of at the edges some of those concerns may surface. But by and large, our view is that nature restoration projects or any other engineered solutions like direct air capture or biochar are high quality, certainly from an additionality point of view. The question on the reduction or avoidance side is a little more equivocal, and one really has to look at the projects themselves to try and distinguish between low and high quality. Vintage age is probably a fairly approximate indicator of something to do with quality, although the theorists will argue against that, saying that it's not, that the project could be a good quality project but just be an old one. In terms of the processes to formalize those definitions, because the words are used, the words are used by SBTI, the words are used by ICVCM, the words are used by the BCMI. So they're being used in policy documents without any clear definitions. I think the ICVCM holds the pen on that at the moment, and we wait, as Ben said, we wait to see where those words come out. I would not expect that to be a single shot game. I think that will be a dialogue which will run for quite a while. I think in principle everybody in the market agrees what is high quality, additional, permanent, no leakage, no harm, etc. It's just putting it in words and defining it unequivocally at the project level that proves a little difficult, or a little more challenging. Did I answer that fully, Ashley?
Yes, thank you. If there are any follow-up questions regarding any of the aspects mentioned in these responses, we can also answer those via email. We also had some questions regarding surplus. So what are the main features that explain the surplus of credits that have been issued but not retired? And what impact will this have on the market going forward?
Mathematically, the surplus is the number of credits, tons of credits that are in 620 million tons that have been issued and posted in the registries by projects, and they're just waiting for buyers to buy them and retire them. So what will affect that going forwards. It's just the ratio of issuances to retirements, and the more issuances there are, if they're greater than retirements, the surplus builds. In theory, the buildup of the surplus in any other commodity market, the buildup of inventory is inversely related to prices in the market. You've got oil markets in terms of storage facilities. It's either a leading or lagging indicator of changes in the market for that commodity. Interestingly, the prices over the second half of last year increased while surpluses increased, which means it does not behave like a conventional commodity market. And one of the reasons is that it's actually, the market is not one market, it's made up of many sub-markets. Red and nature-based solutions really driving a premium irrespective of the number of credits that are in circulation. For others, however, the surplus could weigh down on prices. That's certainly for the sort of the lower price credits of the type renewable energy, energy efficiency, non-CO2 gases. So I think it's a mixed picture. It's a mixed picture, and but the high quality end we expect to maintain its prices towards the end of the year, as the poll actually suggested. But yeah, the surplus is more likely to have an effect on prices at the lower end of the market.
Thank you. We also have a question on CORSIA and pricing. Why are CORSIA eligible futures prices low, while nature-based futures are still higher than the current spot prices? Is it because of an influx on new CORSIA eligible ART TREES credits?
I think there's something to do with that. I also think there's a more fundamental reason that the demand from CORSIA is really not going to materialize in a practical sense, i.e. the need to retire from the international airline industry for many years yet. 2027, 28, 29 is really when the expectations are that airlines will recover to 2019 emissions levels, and it's only then will they start to need to dip into the market. So any buying today is done in anticipation of that and building inventory. And whilst it may seem illogical economically, that still requires a cash outlay from the airlines to basically hedge a liability out 5 to 10 years in the future. And when cash is tight, that arguably discretionary expenditure may not be seen as a priority for many airlines. So I think that is one explanation. And if the person asking the question knows more about sort of our trees, then maybe that is. I would be surprised whether the market is responding to that policy dynamic at this time. I think the market is too nascent and immature at the moment to respond to those forward-looking policy decisions. It's probably more reacting to shorter-term buy-sell fundamentals right now.
Great, thank you. And another question on pricing. How do we view the future potential change in the price premium of RED Plus and nature restoration projects relative to other types of cheaper credits in the next few years? Will this price differential narrow as prices rise?
I think that a lot of the restoration sort of side of nature-based credits will maintain its premium and increase, as the poll suggested. There's a lot of bullish sentiment on where nature restoration credit prices are likely to end up over $20. I think 25% of the poll thought they'd be over $20 by the end of the year. For RED, I think it really does depend on how good the underlying fundamentals of the project are. And for the good ones, good baselines, good management, recent activities, good ecosystem benefits, good community engagement, I think those will be sought out by the market, and that premium will be maintained and enhanced. For the ones that have greater risk amongst those dimensions, then as the market matures and sort of the scrutiny of those projects increases, then the spread, I think, will widen within the red category between good and bad, rather than sort of treating them all as the same. So I think it's sort of a mixed message for red plus. Notwithstanding the fact that preserving the world's forests is crucially important for many, many reasons.
Yeah, if I can add to that, I also see this gap staying, but there could be policy shifts or methodology reinforcements that help drive demand for other project types, right? And it could also be extended periods of market stagnation like now, which eventually lead to convergence, temporary convergence of nature-based and other technologies, right? But the long-term trend is that the gap will most likely stay, if not widen, right?
Yeah, absolutely. Good point. Good point, Gregor.
Great, thanks, Greg and Guy. So we've got another question on policy, so maybe one for Ben. Can you speak a bit more about the intersection of corresponding adjustments under Article 6 and the voluntary carbon market?
Yeah, absolutely. It's definitely a tricky one, but I think it's very relevant, and it's also relevant to you know, the quality aspect of credits that we're looking at as well. And I think it's important to note that voluntary claims don't require corresponding adjustments, and we'll really have to wait and see at COP27 as negotiations get underway if there's any further guidance on corresponding adjustments, because we're really not sure how they're going to materialize in the market. But there is some indication that corresponding adjustments could be almost a rogue indicator of quality. You have guidance from the Nordic Dialogue, which bases its approach on whether the use of carbon credits contributes to national mitigation to meet existing targets, or whether it goes beyond the Paris Agreement level of ambition. So that's really important. And as Guy said, you know, we'll have to wait and see with the ICVCM code to see on core carbon principles, to see at the end of 2022, beginning of 2023, to see whether there is further guidance on corresponding adjustments with that. But yeah, I think it's kind of one of those areas where we're just gonna have to wait and see how they materialize in the market. But there's kind of some links between the VCM and corresponding adjustments, but they're really more for compliance purposes at this point.
Great, thank you, Ben. And we also have a question on the VCMI. So maybe, Guy, this one is for you. Do you believe the VCMI will really impact the demand side? And if yes, when?
Oh, that's a good question. I do think it will. I think the market has been crying out for that. There's been a big gap in the guidance. Every company that we have spoken to, the first question or sort of plea that we get is just, please tell us what we need to do in simple terms. And I think the VCMI has done a fantastic job in trying to put pen on paper to answer that question for their gold and silver and bronze levels. It set out a very high ambition for gold, but left the door open for bronze, for companies to engage with commitments and sort of blend their targets with credit purchasing over the short term, so to give them some flexibility. And I think a lot of it makes sense. Logically and practically, over the time period over which it's going to be bedded in. The consultation, Ben, when does the consultation close for VCMI? Can you remember?
August 12th.
August 12th. Good man. So there's still time. So they're still collecting responses. I expect they'll be very busy in the second half of this year, assimilating and digesting that, and then coming out with revised guidance. And I hope by next year that, as SBTI has done in an incredibly successful way, provide a focal point for commitments, that VCMI also starts to become a benchmark for what companies can communicate to their stakeholders, and with clarity about how, when and how they should be using carbon credits. So I'd say, look, wait for 2023 on that.
Perfect. Thank you, Guy. I think we have time for one final question. So why don't we round it off with a crypto question, since everyone always loves to ask about crypto. So if we can, as a Trove team, elaborate a little more on the developments for crypto carbon tokens, what is the distinction between pre-retirement status and what was ruled out by Vera? What is Vera's logic for this move, and is it tighter standards?
I think that's a difficult question for us to answer, because the question is really one for Vera to answer. You know, why did they make that decision to exclude the transactions of pre-retired credits? So I would actually want to not answer that, because it's not really our in our authority to do that, to speak on behalf of other people. The only thing I could say is that the transfer of the rights for a credit that has not yet been retired, I could pass it to somebody else, and then they retire it. That I think has a fundamentally sort of different claim in terms of how you then use it, because you're taking action then to offset it, use the offset. If it's already been offset, then the action is the retirement, or the action that you're trying to offset has absolutely no change in terms of climate effect, because the credit has already been retired from the market at that point. The incremental benefit doesn't exist because it's already been taken out of circulation. All you're doing is passing on the claim to another person. So that's just a short answer. Can we have one more, Ashley? That is an easy one to end on.
Unfortunately, I think that's all we have time for today, Guy.
Oh.
As much as we do love answering everyone's questions, I think we'll have to save those for perhaps asking via email. But thank you everyone for joining today's webinar. I hope you enjoyed it. Please follow us on LinkedIn and Twitter if you'd like to hear more about our future webinars and events. We'd also love to hear your feedback on how you found this webinar. So if you could please fill in the survey, which you will receive after this webinar. And like I said, if you have any questions, then please send them over to the email below, which is subscriptions@troveresearch.com, or alternatively, send them over to me, ashleypatel@troveresearch.com, and I can relay them to the team. I'd just like to thank the Trove team for all of their hard work in creating these slides, particularly our analysts, Jamie and Hassan, for creating some of these graphs. The webinar recordings and the slides will be available on the Trove Research website tomorrow, so keep an eye out. And we look forward to seeing you next time. Thank you everyone for joining.